define what an impound account really is.
That's actually a good question. We're jumping into this assuming everybody knows, but yeah, let me cover just the basics of that. An impound account, which by the way, in some parts of the country, like back east in particular, they're often known as, in fact, even here in the U.S., in the West, here in California, when you get your mortgage statement, you'll often see that it's not referred to as an impound account. It could be referred to as an escrow account, which can get really confusing because here in California, we have escrow companies. So you're going, escrow company, escrow account, what does that all mean? Well, basic concept with an impound or escrow account is that when you get your loan, you decide that you want to have the lender disperse the future installments of your property taxes as they come due, which in California twice a year, or your homeowner's insurance policy, which of course typically renews every 12 months. So you make a decision that you want the lender to disperse the funds for those installments as they come due. So in order to do that, you've got to, when you close your loan, set up the impound account, and you have to fund the account for both the insurance and taxes with some amount of money up front, so that at the next installment as it comes due, that initial advance amount plus however many monthly payments you are going to make after the loan's closed before that next installment is due, there'll be enough accumulated by the lender to actually pay the installment for you. And the amount that you have to provide up front can be higher or lower depending on the time of the year that you're setting up that impound account, just because of how soon the next installment is due. But once you set up that account, then what's happening is your monthly payment to the lender is not just principal and interest, it's principal, interest, taxes, and insurance. And then what the lender does is pulls out of that monthly payment the insurance piece, the tax piece, and puts them in the impound account, what they call them buckets, for insurance and taxes. And then each month as you make that payment, those buckets accumulate with a higher balance, so that when that next installment is due, for example, property taxes are coming up, the actual due date is November 1, but not delinquent till December 10. So what happens is most lenders don't disperse that next installment until very late November, even maybe the first couple of days of December. Well, if you're closing a refi now, you're not going to have 6 months monthly payments made in order to have the lender have that money available to disperse. So that's what triggers more money up front.